Okay, good morning, guys. Good morning. Well, it depends where you are, doesn't it, really? Good morning, good afternoon, good evening. We've got quite a few traders in the chat right now. Give me sort of a thumbs up, guys. Give me a thumbs up that you can hear me and you can see me. Give me a hands up or mention something in the chat, guys. Please use the chat. I am looking at the chat. I can answer questions. Let me know how you're doing on this Monday morning. Okay, where is chat? Fantastic. I've got the confirmation that I can go ahead now and begin the session. Right. Good morning, guys. Welcome to this live webinar by Alphachain. It is the 25th of April, Monday, just gone past 10 a.m. UK time. And we're going to do our weekly market brief. And one of the key questions that we're going to be looking to answer today is, are we heading into a recession? Are we in a recession? Should be sort of the key question to be asked there, right? So, what are your thoughts? What are your thoughts? Before we begin, what are your thoughts? Do you believe we are in a recession already? I've seen quite a few economists over the weekend actually just mention that the fact that we are actually already in a recession. We're not in a technical recession yet. I'll explain in a minute or so. But do you feel that we are in a recession or we're heading into a recession? Put it in the chat, guys. Please do use the chat. Let me know what your thoughts are. Okay, let's go through it. So I will make sure that I can see my chat over here. Right. So let's begin with US equity markets. Let me just share my camera as well so you guys can see me as well. Just a moment. Okay, someone's mentioned quality of the economy is getting worse. But how can we say a recession? Yeah, we're going to answer those questions today, aren't we? Just give me a moment. Okay. Right, fantastic. Okay, so let me just remove this on the side here. Okay, so as mentioned, inflation and war are serious concerns. Okay, yeah, absolutely. Heading into recession, someone's mentioned that we believe that we're heading into a recession. Fed is going to raise interest rates in May. So yes, we are. Well, the Fed raising interest rates doesn't technically mean that we're in a recession, but we are in a path of all central banks looking to tighten aggressively, apart from the BOJ. GDP is slowing down. Yep, GDP is the main metric used in regards to understanding whether we are in a recession technically. People are aware of rising prices, food, energy, standard of living, and are saving more, spending less, leading to less injections into the economy, heading into a recession. Fantastic answer there. That is the cyclical sort of, process of what you see that leads into a recession. Absolutely. It starts there. Yeah, we will be looking at cryptos. Certainly, we will be looking at cryptos. Absolutely. Let me know what areas you want to have a look at. Let me know what markets you want to look into. And we can certainly discuss some of those markets. Yeah. Energy-based recession. Fantastic. Okay. Right. So Starting the week, what we should be looking to do is focus on the higher time frame. Okay, we want to have a look at the weekly view of the markets. So we should always begin by looking at the higher time frame. So let's switch over to sort of the weekly and the daily time frame. And what we're going to focus on is in the equity markets. Now, I'm just going to zoom in. Maybe we look at. Start with the S&P 500. Now, the S&P 500 is generally used as the benchmark of how the economy is performing. And it's a benchmark used by most portfolio managers, right? So I would certainly always look to review the S&P 500, okay? So the US equity markets had its worst day in months last week, Friday. Yep. So, and it was due to the growing concerns that we saw about a more aggressive interest rate hikes by the Federal Reserve, as, for example, Bullard, one of the Fed members, who came out saying that we should look at a 75 basis point increase in May, but also he defined that by the year end that we should be at 3.5%, where the markets were pricing in 2.5%, in the region of 2.5% to 3% range. And then we had Powell also in his panel. He was part of a panel discussion, and in his panel discussion, he mentioned that we should be looking at raising rates aggressively to tame inflation. Inflation is the biggest overriding concern, right? So we know that the central bankers, the Federal Reserve, are extremely hawkish at this moment. They're very hawkish at this moment. They are, they are looking to take very aggressive steps. Now, the markets do not like that. The markets do not like that. On Friday, we saw the Dow Jones, the US 30, fall 981 points. That is the 11th largest single day drop in history. 11th largest single day drop in history. Yeah. And it's the most drop that we've seen in 2020. Just zooming in, so you can see price action a little bit closer here. Okay. And well, this is not the Dow Jones, we're going to look at the S&P 500, but you can clearly see sort of this is a weekly time frame. Look at the negativity that we've seen over the last few weeks, right? So in the last 3 weeks, we've seen bearish candle formations, and those candle formations, look how large they are. They're gaining traction. Okay, they're gaining sort of, in regards to the volatility. We can see more volatility, and of course, more of a downside pressure coming through there, right? Now, was it only the central banks that led to a lot of this sell-off, right? I don't believe so, right? I don't think it's just that, right? There is other factors. There's other factors that are also in focus here. Guys, if you have questions, I can see some questions being asked directly. Please do put your questions in the chats, okay? Put your questions in the chats, and I'll be happy to address any questions you guys have, okay? Put your questions in the chat, yeah. But this sell-off that we've seen here, this is not just certainly just the central banks that are driving price action, right? The sell-off was broad-based, so we saw all global equity markets fall. So it wasn't a single factor, right? So we're seeing now the sentiment in the overall market moving more bearish. And I'll probably show you a sentiment indicator that we use, right, to really sort of understand how the markets are at times fearful or greedy. And in this case, we're seeing more fear in the markets. But for me, I believe that last week was the key week, and it's going to be very important going forward this week as well, that earning reports are in focus. Okay, that's what you have to be looking at as a trader. If you're looking at trading the markets from a day-to-day perspective, you must be aware of earning reports. Earning reports is what is driving sentiment in the markets. Now, we all know what happened with Netflix, right? So we know that there's a close enough to 40% sell-off in Netflix due to a lack of subscribers, right? A fall in subscribers. But it wasn't just Netflix. We just saw worse than expected financial results across a number of stock market shares, okay, across a number of corporations, right? Verizon, American Express, HCA Healthcare, Gap, all of them came out, quite negative in comparison to what we'd seen in prior earning seasons, earning reports, right? So it seems that shares of, whether it's technology or it could be consumer discretionary sort of items, are being impacted by this interest rate sensitive area that we're falling into, but also supply chain issues as well. Supply chain issues are working in the background. And then, of course, we're seeing interest rates having an impact in companies that are more focused on the technology side potentially. That's why we've seen technology stocks actually sell off further than we've seen the S&P 500. So let's switch over to the NASDAQ 100, or if you're looking at ETFs, you could look at QQQs. With NASDAQ, again, continuation to the downside, similar to the S&P 500, moving but a bit more of a sell-off taking place. We are close enough to testing the prior lows, right? Now, what does, as I mentioned, are we heading in a recession, or do we feel that we're already in a recession? Well, I feel personally that we are already in a recession, right? If you look at the cost of living, as already mentioned, inflation, cost of living, energy prices, all these key factors are leading to much greater sort of, much poorer conditions in living. Right? Those are the facts there, right? Inflation is not the CPI number. Don't just consider inflation as CPI number. The CPI figure doesn't include rent, mortgage, and all of these key factors as well, right? So it excludes many sort of, key factors here. Inflation is dependent on the asset that you're looking to buy. And there's the basket of goods and services that you need to sort of monitor, right? So yes, personally, I feel that we are in a recession. Consumer sentiment is worse than expected. And just to sort of highlight that, maybe I'll just bring up this over here. This was Friday's session, right? So this was Friday's session, right? On FinViz, you can have a look at the heat map of US equity markets. This is what it looked like on Friday. A sea of red. We saw a sea of red. Yeah, it's very bearish at this moment. It is certainly bearish at this moment. Let me just minimize one of these chats for here. It's distracting me. Just focus on this chart for here. Yeah, so we're just seeing a sea of red when it comes to equities and the sentiment there, right? I'm just going to bring up this chart over here. Yeah. Okay, so let me just minimize that. So personally, I feel that we are in a recession. I've heard a number of economists. I was reading the Financial Times, the weekend edition. There was a few economists within mentioning the fact that they feel that we are already in a recession. That recession is already occurring. But the pivotal part to it is also that, are we going to see a recession like we saw previously? Are we going to see a recession like we saw in 2000 or 2008? I don't believe recessions occur in that manner. Is likely to occur for the long term, right? I don't see that there's going to be it's going to be a similar recession to what we saw in March of 2020, right? With COVID taking place, where we had sharp falls, but then of course, they were also buying the dip opportunities there, investors coming in, seeing that where there is a recession, there is opportunity in the markets. That's what you've got to remember. Where there is a recession, there is opportunity in the markets. Someone had previously just mentioned to me over the weekend that during recession is the best time to start a business, to grow, in the area that you want to grow in, right? There is far more opportunity, certainly within a recession. So yeah, do not see that as a as a negative either. So I don't think that we're going to see a long-term fall in sort of equity markets and pessimistic views in the markets. I see that we will see sharp V-shaped sort of formations occurring in markets, but also in sentiment. And I'll probably sort of show you some charts in regards to that also. But technically, yeah, what calls for a recession? What calls for a recession? So if we just have a quick look at potentially now, maybe if I switch over to the S&P 500, we'll come back to the S&P 500, and what we'll look at is, from a technical standpoint, if we look at the all-time highs, which being sort of in this price region over here, around 4,820, and we take it to the sharpest fall. So far, we're seeing a 12.41% of a correction. Okay, so that's what we are in. Technically, we are in a corrective region. Okay, anything a greater sell-off than 10%, to 20%, in that range there, is a correction. Anything more than 20% is seen as a recession. Okay, so we're not technically in a recession. We are in a correction, but it's a correction that lead into recession. Some are already saying that we are already in a recession. If you actually look at sort of the inflation and sort of the key factors from a cost of living view, but at this moment we're not. But if we come back over to, maybe if I look at another equity market, what I want to do is, let's have a look. If I come over to Russell 2000, that's what I want to look at. So I'll look at the Russell 2000 and switch over to the higher time frame. Now, the Russell 2000, these are 2,000 small cap US stocks, okay? And we have a look at from the all-time high down to where we are now. The Russell 2000 has just passed the 20% mark, which means that all small cap companies are facing issues, right? In a rate hiking cycle, small companies are mostly going to be impacted because they're still looking to grow. They're still looking to borrow and grow and expand, right? And yeah, we're certainly seeing they are in a recession, right? So small cap companies are certainly within that recession period. We're seeing more of a 20% sell-off there, 21.1% of a sell-off in the Russell 2000 already, okay? So, small caps companies are certainly being impacted, as you can see, but not as much as the blue chip companies like the Dow Jones, which is sort of in the corrective region here. So certainly I am seeing a lot more bearish sentiment in the markets. Now, coming back over to some of the key factors from last week, as I mentioned, right? So if I just look at this is what we're seeing at this moment here, right? This is the overriding factor why we expect there to be more pessimism or more negative sort of movement in equity markets, certainly, is due to the central banks, okay? So we're seeing, where prior to this, each time that central bankers speak or they do a presser, we're seeing them come out more and more hawkish. Look at the move, the direction of the move expected now, right? We're looking at somewhere between a 50 to 75 basis point rate hikes for the next 2-3 meetings. We're looking at 50 to 75 basis points rate hikes. These are large rate hikes that have not previously occurred in many, many years, okay? And then thereafter, it's going to be tamed to around 25 basis points. And we're looking at around the 3.5% mark, okay, is where the interest rate is likely to be. Now, they are not the only central banks that are doing this. We've already had the Bank of England, for example, raise interest rates 3 times already. We're looking at more of a rate hike occurring in the upcoming meetings. Last week, another key point was Christine Lagarde. She's the head of the ECB. She also turned from dovish to hawkish. Okay, she had a presser a couple of weeks back where she didn't come out as hawkish as the market expected her to be, even though we've got inflation overriding in the Eurobloc. But now she has turned more hawkish, and that has led the money markets to price in further rate hikes, right? So we're looking at almost 80 basis point rate hikes by year end by the ECB also. The only central bank at the moment is not as hawkish as the rest of the central banks, is of course BOJ. And then they are looking towards the Federal Reserve to implement certain thresholds there. We're not going to touch on that as of yet. I covered that in my previous week's sort of session there. But yeah, this is sort of a key factor there. Again, looking at rolling 1 year change in federal funds rate. As I mentioned, when was it last that we had over 3%, the Fed funds rate? Right? We're looking back at February 1995, March 1989. Okay, so these are sort of the periods that we've seen that the markets is expecting a federal funds rate to be at over 3%. Okay, so this is likely to have a significant impact on the equity markets. Why is that? Well, yeah, when you have tightening cycle occurring by central banks, what they're doing is they're reducing the money supply, right, which makes it harder to borrow, right, and less likely to borrow because you're paying a higher interest the funds that you borrow. So companies that are looking to expand may not look to expand. They don't want to buy another factory, sort of, expand their operations as such, right? So yeah, and then if that's occurring, we're going to see them potentially not hiring as many individuals or looking to reduce the amount of staff they have. And then those staff members will look to now, not spend much in the economy as well, because they're not earning as much as they once were, right? So, it has all a knock-on impact in the equity market, certainly there. Okay, so that covers one element of this. I think the second element is how the market is facing at this current moment. What do they feel at this moment here? It certainly begins with the consumer confidence, right? So when you are looking at interest rates and the central banks, what they are doing in regards to raising interest rates, what you also have to look at is the consumer sentiment. And consumer confidence index is a great gauge in understanding how the markets are potentially fearful or greedy at times, right? Now, have a look at this. This is a great sort of reflection of what's occurred over multiple years. This is going from 2000 to where we are now. Okay, so in 2001, look at what the sentiment was. 100 being sort of your key, bar. That's the sort of the key sort of threshold that you don't want to be below, right? So, during the 2001 sort of dot-com sort of crash, the 2001 dot-com crash, we saw it test that region there. Around the 2008, we had it fall way below, around close enough to the 96 handle. Thereafter, we've seen a bull trend occurring. And in March 2020, we saw a substantial fall and then almost a pullback. But notice how it didn't pull back above the 100 mark. Okay, it just came back up to sort of that region. And now we have the continuation since, we've got a lot of other key factors having an impact. So it's not just the war in Ukraine. I wouldn't factor that just the war in Ukraine. I'm also seeing that reflected in, of course, inflation. So all these key sort of areas that I'm going to mention in a minute or so. So yes, this is the US consumer confidence, which is turned negative, turned bearish, back to those prior lows of 2008 global financial crisis. We also have the EU consumer confidence, which is in there. We have the EU consumer confidence. So you can see where it was in regards to the 2001 dot-com crash. Look at where it was in 2008, global financial crisis. We also have between 2012 to 2015, the debt crisis, right, that began in Greece that had occurred, which led to a lot of pessimism. But, we had 2016 Brexit vote. But look at March 2020 with the COVID pandemic, a substantial fall there, a retracement, and now continuation to almost back to where we are, back to those prior lows as we are currently, right? Whether it's the war in Ukraine or other sort of overriding factors, I think there's too many factors at this current moment that are really leading to this pessimistic view in the markets and what we feel is a potential recessionary period. Okay, something else to also mention here as well while we're at it is the value of global bonds. Okay, so as we see that the bond market is often seen as the asset class that you go to for safety, right? It's that it's well, they say it's secured, but it's not secured unless the government can default. But 99% it's as a protection level. But okay, so in the current market conditions that we're in at this moment, with this hiking, the hike that we're seeing central bankers are looking to take place is now raising interest rates, right? The yields are rising, but then we're also seeing at the same time that's going to have a knock-on impact on the price of bonds. The price of bonds are falling, and that's what we're seeing over here. So yes, absolutely. This clearly is showing you that we're seeing global bond prices fall, right? And there is a less demand in bonds at this current moment as well, in my opinion. So we're seeing total loss from all-time highs is around the 6.9 trillion mark. Okay, that's a huge loss in the bond markets, a huge loss in the bond markets. Okay, this is reflective up until Friday. What was the day? I believe it's the 22nd. Yep, so up until Friday 22nd, I'll put this together in regards to asset classes year-to-date total return. Commodities still is outperforming, up over 40%. Of course, oil around 38%, region. We've had a bit of a pullback, a bit of a correction. We'll have a look at those markets in a minute. So gold is, we can come back to and review gold also, but it's up 6.4%. Dollar is rising. We're seeing a lot of dollar strength come back through, around 5.1%. But look at this. This is where you can see now there is where a shift in risk off to risk on and risk on to risk off is occurring. It's more likely that we're seeing that risk off asset classes are outperforming at this current moment. Okay. So stocks are down, high yield corporate bonds are down, government bonds are down, investment grade corporate bonds are down, Bitcoin is down. So yes, we are certainly in a risk off environment. Okay, I will switch back over to look at the equity markets. We'll come back over to the S&P 500. We'll have a quick look at some of the key sort of markets here. The four that I tend to follow. So on an ongoing basis is S&P 500, NASDAQ. So we've seen them both almost testing and almost arriving back to the prior lows. We're quite close to those prior lows, all going up to sort of a key level resistance and then selling off. The key level for NASDAQ is now the 12,955 region. That's the prior low there. For the S&P 500, we've got a zone in between the 4,100 mark to the 4,140 region there. FTSE 100, it seemed, to be the only equity markets that still outperformed in comparison to the other sort of US markets, right? And that's largely because we're seeing that shift from where we've seen risk on to risk off, but not only going into safety assets, but we're also seeing that market participants are looking for value. They're looking for not high growth stocks, right? They're not looking to take more risk. We're seeing they're moving more into value assets. And the FTSE 100, those are multinational companies, vast majority of them, and some of them have a very good sort of value proponent behind them. So yes, FTSE 100, we can see sort of, went on to test prior highs again. We're quite far away from those prior lows yet, but we are moving to the downside now. We're seeing that shift move to the downside after rejecting sort of this key level of a trend line and resistance zone there. The DAX also continues to fall, moving lower, but we're seeing European markets are being less impacted by US markets at this moment, right? So the European markets are lagging behind the falls that we're seeing in the US markets, certainly here, right? Okay, so that sort of gives you sort of an overriding view there. Moving over to gold, we'll have a look at gold at this moment. Now, gold should be outperforming in this current sort of climate. At this moment, it hasn't, right? So we're seeing just all markets in the negative territory at this moment. We've had one test. We've had that single sort of test there back to those prior highs, right? So that first test to the prior highs, we're now back in that correction zone over here. We're looking at a key level of support at this moment. That's where we're testing at this moment here. So you can see how beautiful is that sort of test there, right? So what type of candlestick is this, guys? You guys must know this type of candlestick being formed here. What type of candlestick is this, right? It's a long-legged doji, right? It's a long-legged doji being formed at this low here and at this pivotal support level. And look at how many times this region has been supported. Yeah, and not just recently. This level has not been supported just recently. We're seeing it being supported previously back May of 2021, right? So May 2021, it was a key level resistance. It's been tested prior to that as well. And we're back there again. So it's back at a key level of value, right? A key level of value. The question is now, are we going to see more of a hawkish move, more of a bullish move occurring, right? I'll let you determine sort of the direction at this moment there. But this is the one that I'll be looking at, especially today. Moving forward to the oil markets. So the oil markets continue to correct. Now, why are we seeing this move back lower? Now it's back below the 100 mark. This is largely down to what's taking place in China in regards to the COVID cases. We're also seeing, while we have all these overriding factors, inflation, central banks tightening, we're seeing poor earning reports coming through. But COVID cases are also gaining traction at this moment. And we're seeing how certain countries have very low vaccination rates, but also they are certainly putting in place restrictions and lockdowns that could hinder supply chain and then hinder sort of the economic activity that's occurring, certainly on a global scale. And that's what's taking place in China at this moment. So I do fully believe that oil markets are certainly being mostly impacted by what we're seeing with China. What I would say here is now there is potentially the EU at this moment discussing an embargo of Russian oil. Now, would that have an impact on the oil market? Certainly will. It certainly will. But again, you need confirmation of this. You need confirmation of this. And the more that we hear about this, the more that information will get discounted to price as well. Okay, so just note that when the surprise effect is what leads price action to move in a very hawkish direction or in a very bearish direction. Okay. Right, so yeah, oil continues to converge. We're seeing convergence back to sort of key level of support, but I don't believe that it's going to break lower than 95 handle. We've had one test through the 95 handle, sharply rejected that level. We saw it come back up to sort of test the highs around 110, close enough to 110. Since then, it's back down sort of below the 100 mark. We're again back at a key value area. We're waiting for more impetus. We're waiting for more catalyst to come through so we can make further decisions in which direction we're likely to go. But it seems that you need to be aware of what's taking place with the COVID spread in Asia, in the Asia Pacific region, okay, because they have a very low vaccination rate, and it seems that their government is certainly looking to take a lot more aggressive stance in regards to restrictions and lockdown to ensure that they tame and control COVID cases there, okay. And I don't have that image, but I saw an image that you'll be quickly sourced online on Bloomberg, where it showed the number of ships that are just around this, around ports in China, Shenzhen in particular, just waiting to sort of offload and onload sort of goods. How is that going to impact markets 6 months from now, right? There is certainly a supply chain issue in a backdrop that's not coming to sort of being one of the key themes that is driving market conditions at this moment now. Yeah. Okay. So moving on. So let's have a look. So oil markets at this key region here. If we're looking at, I'm just going to switch to a different screen here. Okay, looking at now potentially more FX markets. Of course, one of the key areas to focus on at this moment is just looking at the dollar index. Okay, so dollar index, looking at the daily time frame, it's continued to move in a very bullish manner. It's surpassed the 100 barrier. It's not quite at sort of a key level of resistance yet. That's still all the way up to around that 102.80 mark. But yep, in a very bullish stance over here. You've got the US 10-year yield that I'm looking at here that's broke through sort of a key trend line that I've placed here, not quite at the resistance yet, but again, moving in a very hawkish, bullish direction. And as we see, with a lot of dollar strength coming through, its pair is also going to, reflect that as well. So if you're looking at euro dollar is falling because euro is becoming weaker and dollar strengthening. Even though over the weekend, one of the key factors that had occurred was the French presidential election. Now, looking at the French presidential election, Emmanuel Macron is back for his second term. They usually it's 4 years, but then in France it's 5 years. So he's going to do another 5-year term. Okay, he's already done 5 years. He's doing another 5-year term. Now the biggest concern to markets, from a market perspective, it was between two individuals. It's between Macron and it was Le Pen. Right now, Le Pen is a far right candidate. So that would bring a lot of risk to markets, capital markets. Whereas Macron is, he's previously worked as an investment banker. He's already got a bit of a track record, already serving a 5-year term and being capital markets positive. So the markets took that in its bullish stride. But hey, we've got overriding factors impacting markets right now. I think there's bigger concerns than the French election. So it didn't have too much of an impact, but I would have expected more of a euro sell-off, euro side sell-off, not dollar-based, euro side sell-off, if we'd seen Le Pen, inch and sort of break that threshold there in regards to winning the election. But yes, it's worked out in the favor for the euro, but again, overriding factors are more of a concern. So that's one of the factors that's been removed. Now the focus is, okay, what are sort of other sort of key elements there? We're seeing cable. Have a look at cable at this moment. Sharp sell-offs. Okay, so we're seeing sort of this downtrend line in play, and we're looking at a downtrend line in play from going as far back as last year June. Okay, May, June, right? So that's the prior sort of key high 1st of June, right? Since then, we've had a sharp downtrend, breaking prior lows. Look how we're sort of consistently breaking prior lows. A bit of convergence in this region over here. Then we broke out of this consolidation, testing a new low around the 130 handle. Look at psychological numbers. Psychological numbers are key factors here, right? We tested 130. We rebounded off the 133 handle, and now we're falling back through the 130 handle. We're now testing 127 handle potentially. We broke through the 127.50 handle at this current moment. So a very bearish outlook in sterling at this moment. Okay. Now, let me switch over. One of the key sentiment indicators that I tend to look at is the VIX. Looking at the VIX, the volatility index, right? And I have two VIXs here, the VXN and the VIX. One looks at the Nasdaq tech stocks. One looks at sort of the SP 500. Okay, both have moved in the bullish direction. Both sort of almost testing the 30 handle. So yeah, we can see certainly there's a lot more fear, a lot more panic in the markets at this current moment, and those recession fears are certainly being stoked up. Not only from what from my research that I've carried out, but we've had, for example, what I could mention right now is Goldman Sachs. Goldman Sachs mentioning that the US recession. Hang on, let me just actually share this with you guys right now. So Goldman Sachs have mentioned this recently, and I'll just share this right here. Yeah, so recession's risks have climbed for the US economy, and certainly it has climbed in the UK market as well from my research here. Goldman Sachs has mentioned this, and Schroders also mentioned this. The recession risk over here, you could see, has gained is over 30%, it's around 35% mark here. Now, what this is showing us, right? That doesn't mean that what they've also mentioned is that surely when we're above 30%, we see within 12 to 24 months a sort of confirmation of a recession, right? But there is that lag, right? There is a lag, because what we need is 3 to 6 months worth of negative GDP, or we look at from a technical standpoint, you look at the highs from all-time highs, more than 20% of a sell-off. We've seen that already in the Russell 2000, right? So yeah, just looking at previously, you can see sort of when the last few recessions were. So with the 2000, we saw sort of above the 35-40% mark, and then we had a recession shortly thereafter. We saw that again occurring with a delay in 2008, between sort of 2006 up through to 2008. We saw that percentage being over 30% at that moment, and we're seeing sort of a similar reaction at this current moment here. Okay, shifting over, shift back over. So yeah, let's if you're looking at the most riskier asset class at this current moment, you've got to be looking at crypto assets. Okay, crypto assets and how they faring at this current moment. Well, not so bad. I mean, I expected a bit more of a sell-off occurring in the crypto space. Certainly, considering sort of all the key factors I've mentioned in this conversation, this discussion here. Yeah, so I'm going to be shortly coming to an end, guys. So if you have questions, put your questions in the chat now, guys. Please put those questions in the chat. I'll be happy to sort of address any of those questions. Let me switch over to another screen. Let's look at. Okay, the two sort of okay, so the two sort of markets that are from a crypto space that I'm viewing on a sort of day-to-day basis is Ethereum and Bitcoin. Okay. Now, you must remember, and the key factor that I mentioned about the crypto space, it's a new asset class. It's a very new asset class. I think Kevin O'Leary mentioned in regards to, it will eventually look to be allocated as a new sector within, the 11 sectors that we currently have and we've also sort of, got to mention the fact that the adoption rate and the amount of sort of the percentage of adopters still is somewhere between 50 to 25% region, depending on who where your sources are from, right? So certainly, it cannot be seen as a safe asset. Bitcoin cannot be seen as a safe asset because of its scarcity at this current moment. In the future, it may do so, and I'm certainly viewing it that way. But at this moment, it's a beta to technology stocks at this current moment. Okay, technology stocks are underperforming. We're going to see this have an impact in the crypto space, right? And that's what we're seeing in this current moment. And there's a high correlation between technology stocks and QQQs and the Nasdaq with the crypto assets than there is that correlation with gold at this moment. So certainly in the very, very short term, if we see a lot more pessimism, a lot more sort of fear in the markets, we're going to see individuals sell some of those crypto assets and go to more safe assets. Okay, and that's what we're likely to see in the crypto space. Now, if you're looking for value, that's great though, because that's allowing you to buy in and average down into sort of lower prices for crypto assets for the long-term opportunity, right? So yeah, Bitcoin at this current moment is testing around 38,500 figure. We've got a key trend on a place over here, sort of, again, even if it breaks through this and comes back and tests the prior lows, there is that risk, right? There is more risk to the downside than there is to the upside, in my opinion, at this current moment. Now, Ethereum, similar price action, we're seeing it break those prior lows, right? So it's breaking sort of those prior lows. But again, the key support level will be around the 24, 27 handle, testing that region here. We've certainly in a downtrend. Okay, we've got lower lows and lower highs being formed. We are in a downtrend. The question is, when are we going to see the next key level support being held? Okay, and it could be that we see a continuation down to these sort of key levels of support that I've mentioned already. Okay, that's the view in regards to sort of the markets for the week ahead. Let's have a look at the economic calendar. What I might do, let's just this, hit refresh this week. Okay, looking at the week ahead. Now, as I've mentioned already, right? Overnight, we've had Chinese stocks fall. They've faltered further, and they are sort of, in a very precarious mood, in my opinion. A lot of it's been government sort of driven as well. Just be careful in investing sort of in Chinese-based stocks. Certainly right now, sort of all the government sort of interventions that has occurred. But and they've got of course a property market concern as well. So there's a credit risk there as well. So for the week ahead, looking at the week ahead, so we're looking at high impact data. Okay, we're going to look at high impact data. We've got BOC Governor McClain to speak at some point this afternoon. Tuesday, mostly sort of low impact news. Just be mindful of the consumer confidence report at 3 p.m. UK time. Overnight, Wednesday, sort of early hours of the morning, we've got CPI data out from Australia. We've got a BOJ outlook report taking place on Thursday. We've got the US GDP quarter-on-quarter figure. Just be mindful what you see there could stoke further recession fears, certainly, right? And then going into sort of the close of the week, we have the core PCE price index month-over-month figure to be released. Now, this is one of the key metrics used by the Federal Reserve, by the Federal Reserve members in regards to outlining how markets are, what their next move may be in the upcoming meeting. I believe it's on the 4th of May, right? And if you're looking at central bank interest rates at this current moment, we've got the Kiwi at 1.5%, CAD at 1%, UK sterling at 0.75% interest rate, just shy of 0.5% in the US, and look at Swiss franc at negative, and also the yen have been in negative territory for some time, but the vast majority of these from euro through to Kiwi are likely to raise interest rates in a very hawkish manner. Okay, fantastic. That sort of wraps up the weekly brief, guys. And the sort of the key point, what's driving markets at this moment is the panic and the recession fears. Okay, recession fears is what is likely to impact markets. Questions. Let's have a look if there are any questions at this current moment. Are there any questions at this moment? I'm just going to have a look at the chat. As you look at, so there is a lot there in regards to what you look at in regards to recession indicators. Okay, so if I just break it down into 3 sections, actually, I've got it right here. Actually, I was making some notes myself. Right. So in regards to really understanding and forming your own judgment in regards to are we in a recession or not, what I would suggest is you look at sort of 3 key elements: market internals, market breadth, and sentiment. Those are sort of 3 key factors that you need to look into, right? So let's start with market internals. What that means is if you look at the S&P 500, what I want to look at is how are the companies within them performing, right? And the internals could be, for example, how many of those companies are making new highs, how many of them are making new lows, right? By really sort of outlining that, okay, there are less companies making new highs and more companies making new lows, that shows you that overall the corporations are performing negatively, right? Or you could do a cross-check like we did similar to this session here, where we looked at the S&P 500 and we looked at that versus the Russell 2000, right? Small caps versus large caps, right? So look at new highs, new lows, look at sort of, different sort of small caps versus large caps. You can look at heat map. I've shown one of those sort of key heat maps from the prior day's session. You can have a heat map that shows you, a week's worth of sessions, a number of weeks worth of, a few months worth of sessions as well. So those are market internal sort of that you're looking to sort of, gauge and understand how sentiment is. Then I would say, let me just shift this on this side over here. Then the second part will be is market breadth, right? So, now that could be assessing these key indexes, like for example, the S&P 500 by applying objective indicators. So for example, how many have crossed, so if the S&P 500 and you look at you apply 2 moving averages. Let's simplify it. You put 2 moving averages. You put the 50 and the 200 period moving average on your S&P 500 on the daily time frame. How many have fallen on the death cross? Right. Have a look. Is it through the death cross? How is price action? Has it retested the prior 50 handle or the 200? Or is it below the 200? So assessing sort of the breadth of the equity markets or gold markets, or whichever markets that you're looking at. Trend index is another sort of indicator that you can look into that will also help you with assessing the breadth in the market. Looking at sentiment, so this is sort of the third element there. Looking at sentiment, well, I've shown you one in this session here. Look at the volatility index. The VIX is a great sort of view whether there is fear in the market or there is greed in the market, fear and greed, right? We can clearly see in the crypto space, I think there is I can't remember where I receive a newsletter from somewhere, and they show me on a week-on-week basis the fear gauge of the crypto space. And we are in the fear and the worst position possible on that fear gauge at this current moment. right? So that would be one indicator that you can look into. I tend to apply the VIX and the VXN, which is looking at the NASDAQ and the S&P 500, and I'll overlay them both as an indicator and view it that way. Because those are two markets that I'm focused on, S&P 500 and the NASDAQ. Another sentiment indicator, the put-call ratio. Look into the put-call ratio. Now, what that is showing is how many of the market participants are putting in protective measures, right? How many of them are putting in a hedge because they are fearful what's likely to occur, right? So that's another sort of sentiment indicator that I tend to look at on an ongoing basis to really sort of help me understand, where we are at this current moment. Now, don't be the last person to know that there is a recession at this moment. You need to be ahead of the game. You are all market participants. You can easily download a TradingView platform, look at the markets, and be the informed, not the uninformed. Okay, make great decisions and have your own decisions that you can make. Don't wait till it's determined that we're in a recession, and then you miss the lows, you miss the opportunities that come from a recession as well. So try to be sort of ahead of the game. Really think about inflation, but look at not just the CPI inflation. You might look in one of the UK measures is HPI, which includes housing prices as well, rents and mortgages within that calculation, and compare the two, right? So really go into the reports that are being released by, for example, Office for National Statistics that produces the CPI sort of reports in the UK, for example, right? So yeah, really sort of do the research. Look at the markets and all the sort of key indicators like the market internals, market breadth, and market sentiment to really engage whether we are in a recession before it's confirmed as a recession, and you will be ahead of the game. You will have the best opportunities that you can sort of take advantage of going forward. We'll end that right there, guys. Those are sort of key tips there that you can take away from this session. I look forward to the next session we host. Any questions, where to reach me. You can sort of send me a direct message within our Slack group if you're one of our members. If you have any other questions, you can always email in at hr@alphachain.co.uk. Fantastic. I see you in the next session, guys. Enjoy the upcoming trading session. One key point, I know that most of you are trading from a global macro perspective, but you need to know what's happening with earnings. This week is very heavy in earning reports, okay? I've gone through the economic calendar, that's the macroeconomic calendar. Look at the microeconomic calendar as well. On investing.com, you can look at the microeconomic calendar and see the earning report releases and be notified of those releases. We've got some really important ones to be released. I think Tesla's coming up shortly as well. So no, I think Tesla already came out last week, but we do have quite a few reports that are quite important for the equity markets. This week is the most heavy part of the earnings season. Okay, that's where we have the most reports being released this week. So that's where the focus is going to be with traders. Of course, you've got overriding factors from geopolitical with Russia, Ukraine. In the backdrop, you've got inflation, you've got central banks. So right now, there is a lot of catalysts in the markets. But in my opinion, the focus is on earning reports. Okay, enjoy the week ahead, and I'll speak to you guys soon. Take care. Bye-bye.